All right, what is up, traders? What's up, tycoons? Super excited for today's video. Lots of people keep screaming about the recession coming. So we've got to actually dive deep into the data and look at some of the factors that could actually cause a recession in the market. So we're going to fly through a bunch of things. We're going to talk about mortgage rates, the median monthly mortgage payment. We're going to take a look at how the home buyer has basically been crushed in purchasing power. And then we'll also go over the median U.S. asking rent. All right, we'll take a look at how households have deleveraged, and then we're going to take a look at how this is reflected in some real estate stocks. We've also got to talk about small banks. Okay, there's some, crazy developments basically we're seeing in small banks. Of course, that's been reflected in regional banks. All right. And we're going to talk about how, there could be an even bigger storm brewing about to happen for these regional banks, right? Largely due to treasuries. We're going to talk about how the treasury auction sizes have basically led to the largest sell off in bond market history. We're literally living through that right now. So, if you plan on keep investing for 20, 30 years, you'll be able to tell this to your kids and your grandkids in the future, how you live through this. Okay. Now, speculative traders have also gone very bullish on the dollar. We're going to talk about why that's bad for the stock market and what that could potentially mean. So we're going to break down all of this in today's video in detail. But as always, the content provided on this channel is just for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. Don't forget to smash the like button and subscribe to the channel if you guys are new. Now, if you're new and you're not familiar, I actually started a completely free newsletter called Investment Intelligence, giving out really good, free, valuable finance content. And I also try to sprinkle in some trade ideas in there. This is a trade idea on Tesla from over a month ago now. And you can see that trade played out very nicely, especially if you trade something like options. But not all trade ideas are going to be long positions. Some of them are also going to be short positions. We had a trade here on SWK. This is Stanley Black & Decker, highlighting the rising wedge, going over some of the targets that we could see it coming down to, and it played out very nicely on that one. So if you guys are fans of free, valuable content, as well as free trade ideas, sign up for that newsletter. There's a link in the description as well as the comment section. Now, let's get into the video. And typical mortgage rates now range some 0.4% above or below the average rate. That is more than double the range during the years before the Fed started raising rates. Mortgage rates are something that are just crushing a lot of people right now. And even people that, are sitting on a nice amount of equity right now and maybe perhaps even want to sell their house, it doesn't make a lot of sense for them to sell their house and go get a ridiculously high mortgage right now. So, I know a few people who are in this situation, and there's a lot of Americans in this situation right now. The median monthly mortgage payment is up 10.2% year over year and at an all-time high. So what we're looking at is the median monthly mortgage payment is at $2,700 right now, just over $2,700. This is absolutely ridiculous, right? I mean, when you take a look in 2021, the highest it went was still below 1750. So we've seen a very dramatic increase, and basically you're paying $1,000 more on your mortgage payment in the last 2 years, and simply just the last 2 years. I mean, look at these 2020 prices, right? The highest it got was barely spiking above 1,500. So, if you got in here, around the 1,400 area back in 2020, mortgage payments are almost double, right? Literally almost double in just a matter of, 3 years. Really crazy stuff. Now, a home buyer on a $3,000 monthly budget has lost nearly $40,000 in purchasing power over the last year as mortgage rates have risen from around 6.5% in October to nearly 8% today. So, essentially what you're looking at is how much home can you afford as mortgage rates change? And this shows the home price you could afford for different monthly payment households based on the mortgage interest rate, assumes a 20% down payment, a 30-year mortgage, 1.25% property tax rate, and then 0.5% homeowners insurance rate, and no HOA dues. And you can see here that it's just absolutely insane, right? And you've lost a lot of purchasing power, especially people on this range of a $3,000 monthly budget. I mean, that used to be a healthy budget just a couple years ago. You used to be able to pay your mortgage, pay your insurance payments, pay your car payments, pay your car insurance, and also your various other bills, and still live comfortably and have a nice house. And we're just seeing a much different environment right now. The median U.S. asking rent rose 0.4% year over year to $2,011 in September. This is the sixth straight month in which rents were little changed from a year earlier. So they're starting to flatten, but still they're just very high right now, very elevated. And this is causing a lot of people, a lot of pain, right? So not only is it very expensive to rent right now and staying at these elevated levels, even though it's flattening out and not necessarily increasing, if you wanted to go buy a house, it's extremely expensive right now and to stop renting. So kind of a double whammy for people who don't have a home yet. Households have deleveraged their mortgage debt since the last crash. Mortgage debt as a share of disposable income and a share of real estate assets. Basically what you're seeing here is you're seeing this massive deleveraging, right? Where before they were leveraging in, and now there's this big deleveraging happening here. Realty Income Corp, right? This is a very popular real estate dividend stock, ticker symbol O, all right? And a lot of this stuff is being reflected in the stock market, right? This stock is down 33% from the peaks in 2022. The real estate sector as a whole, XLRE, also down from its peaks in 2022, down 35%. It started to rebound here, but things don't look pretty, right? Especially in the real estate stocks. And a lot of that stuff makes sense based on what we've seen in the data. Now, U.S. small banks credit card delinquency rates hit a multi-decade high. Okay, and this is very troublesome for these smaller banks and these regional banks. When you take a look at the KRE regional bank ETF, this thing does not look pretty. Okay, I mean, yes, it's bounced from the lows that I had, but overall, I mean, this is not a beautiful chart, right? This doesn't scream raging buy, right? This isn't screaming buy. And the Q3 sell-off in treasuries could push banks' unrealized losses back to recent highs. And so what this means is that, remember, the whole Silicon Valley Bank collapse was caused because of the treasury yields and how high they were. Treasury yields since then have actually went higher, and they went significantly higher. So, this is very troublesome. And this is causing banks to have a bunch of these unrealized losses. Earnings season is starting yet again, and we're going to have some of the major banks kicking off earnings season here very soon. Now, Treasury auction sizes will increase on average 23% in 2024 across the yield curve. The significant growth in the size of the Treasury market is at risk in 2024 of crowding out demand for other types of fixed income. Treasury auction sizes, again, will basically increase on average 23% across the yield curve. And that is very significant, guys. That is why we're seeing such a sell-off in treasuries and why we're seeing such a spike in treasury yields is basically part of the debt ceiling deal is they're just going to keep flooding the treasury market with more treasuries. The Fed is no longer doing quantitative easing where they're coming in and buying in U.S. treasuries. They're actually doing quantitative tightening, the exact opposite. And that's putting a lot of pressure on the bond market. And that's what's really been behind, or some of the factors behind the largest sell-off in history in the bond market. This is the BND ETF. This is basically your total market bond ETF, just kind of encompassing everything. And you can really just see the massive, I mean, this is a huge bear market, guys. This is a multi-year long bear market. There are bear market rallies within a bear market. So it's very possible, these bonds could recover, over the next few months, maybe the next 3 to 6 months. Let's just say they do rally, but you have to keep in mind that they're still in a bear market and there is something known as bear market rallies. And we need to be really cautious of that heading into the future. Now, of course, a lot of people are under the assumption that the Fed is going to cut rates in 2024, and that will, they have the assumption that that will help bonds and help bonds get out of this essentially bear market that they're in. That's definitely a possibility, but you want to keep an open mind to all the possibilities so that way you're prepared for the different scenarios and you're not over leveraged on one side of the trade without any type of proper risk management. Now, speculative traders have raised their long bets on the U.S. currency to the highest since June. And basically what we're seeing is that they turned bullish on the dollar yet again here in September, or back in September. Okay, and what we have is the US dollar, the Dixie index here in green, and then we have the stock market here in white, and you can see how inversely related these are. Okay, as the dollar index is rising, the S&P 500 index is declining. Okay, and as the stock market is, the S&P 500 index is climbing, we see here that the US dollar index is declining, and we've seen this, pretty rapid raise or rate of increase in the Dixie, the dollar index here. and we're seeing the stock market decline. So, basically, if the dollar is going to keep being strong, that's going to be a headwind for the stock market. And ultimately, you would need to see the dollar fail here and start to decline back lower. Okay, if you ultimately want to see, the stock market have a better chance of performing better and continuing to go higher. But continuing with that recessionary theme, a lot of people are expecting stocks to drop pretty significantly. In a recession or before a recession / during a recession. And, the US dollar is definitely something that you're going to want to pay attention to. That's something that definitely, affected the price of stocks back in 2022 and is still affecting the price of stocks today in 2023. Now that's it for today's video. Don't forget to sign up for that newsletter, Investment Intelligence. Link is in the description. And if also, I started a Ko-Fi page. So if you guys ever want to reach out to me directly, Ko-Fi is the place to do it. You can come here and you can book a 30-minute session or a 1-hour session by clicking on the commissions tab. In there, you also will find a segment where you can request a specific YouTube video. So if you want me to make a YouTube video for you on the topic of your choice, Ko-Fi is going to be the platform to do that now, so it doesn't get lost in the comment section. As well as, if you ever enjoy the free valuable content I put out for you guys, you can always click on this buy a coffee button, and it's basically a way to leave a tip or a donation, for the work that I put into these videos for you all. Thank you all for watching again. Don't forget to smash the like button and subscribe for more.